Good morning, Richard Calhoun, Creekside Realty. We're here to discuss the real estate marketplace, and we're going to, for the first time, talk about the Greater Bay Area. We're going to be looking at single-family homes only. We're going to be looking at 13 counties. They're in groups. We have Santa Clara County, San Mateo County, and Alameda County in one group, San Francisco and Marin counties in a second, Sonoma, Napa, Salona, Contra, Costa in a third, San Joaquin and Sacramento in a fourth, and Santa Cruz and Monterey in a fifth. This is going to be the first time going through this detail, so let's jump into it. Here's looking at inventory, and inventory is one of those data points that if I do not get it in real time, I can't go back. So there's no way to go that I'm aware of. So if anyone out there knows how I can get active, unencumbered listings for the different counties, then I can go back and fill in the data retroactively. But you can see that I got like 2 data points for all 5 areas that we're looking at. The one that is everything is what I'm calling Silicon Valley, which is Santa Clara County, San Mateo County, and Alameda County. Basically, that's what we've been looking at, but I've dropped off Contra Costa County, putting that in with the North Bay. Here's the volume of number of offers accepted. So you can see each category, and the colors for each area is the same from slides. And I also bolded the Silicon Valley one, which is Santa Clara County, San Mateo County, and Alameda counties, which is what we've been basically discussing in the past. So you can see that one. But the big takeaways are the trends in all counties are roughly the same. They may happen at different times, but they're roughly the same. You can see the impact of COVID. Also notice very recently, there's been a weird fluctuation for Thanksgiving that hasn't happened before. I actually believe that is in the methodology of my data acquisition. I was working on that just before I started the meeting. I don't have a complete resolution, but my suspicion at this moment is it's got to do with more listing agents requesting their listings continue to show while they're in escrow, which would be an indication of a weakening marketplace. It used to be an insignificant number. It currently looks like it's a significant number, and I'm going to dig into it, make sure I get reporting accurate data. But I think you need to ignore this dip down. I think it sort of comes down and then goes to this data point, but I'm sorry, I really don't know. You can see the dip down, and yes, there's a dip down, but the dip down, as you can see, happens at the end of the year, not at Thanksgiving. This is a steep decrease. Now, the other thing that could be happening, which I've observed, is the COVID has impacted people and they're taking holidays more seriously last year and this year. And if more people were doing things related to Thanksgiving, the decrease that we would have seen for Thanksgiving would have been steeper, which is what we saw and maybe the data is accurate. I just don't know, and I just want to raise that as a concern that I have. And this I'm showing, I have people that are debating both ways. This goes back to 2014, so you got 10 years worth of data. I feel that this area is too congested, and I would rather display 5 years of data. So if I could get people to comment on whether they want 5 years or 10 years of data, that would help, and I'll use one or the other. I won't flip back and forth. But by using 5 years, the horizontal scale is more spread out, so you can see the Thanksgiving dip and then the return, and now we're starting to go into the end of the year dip. The question really is this dip real, or is it a figment of how I acquire data and more contingent offers? Days of unsold inventory, because the number of offers accepted dipped down, it shot up and then came back down. The real trend may be a more gentle curve. And again, the other new areas, they'll start showing up historically, but long-term, I only have the Silicon Valley data. Days on market, I can go back and get that. So this is sort of a substitute for the areas that you don't have days of unsold inventory. Here is median, and I don't really like median for this purpose because you can see the boxiness of it, the jumpiness of it, and that's because it uses actual data. And on median days on market, the advantage of that is you can understand that 50% of the homes are getting more time on the market, 50% or less time on the market. For understanding the market, I like this better, which is the 75th percentile, which means 25% of the homes take longer and 75% of the homes sell within the time frame shown here. But you can sort of see these will reflect DUI. Now, it tends to lag behind and the change isn't as much, but it will let you see the other areas that we don't have historical DUI for. And it also shows you that the areas, for the most part, follow the same pattern. I am noticing little things like San Francisco have this big dip that seem to repeat, which seems to be a San Francisco phenomena, and I don't understand why, but it appears to be real since it's repeating year after year. Here's the magnitude of overbidding. This is where you take the sale price to list price ratio average, which I think is a pretty significant thing. It's showing how much pressure the buyers are feeling. And you can see, again, the trend for all 5 areas are very similar. You can see the huge decrease. You can see that we're plateaued a little bit, but now we're starting to do a more gentle decrease. This is the steepest, most sustained fall that I have in the year period of time. We've had other significant falls, but you can see the slope is less, but it's also the highest we went. And you can also see we went up much more steeply. So it makes sense that we're coming down. Long term, we're getting back to the long-term equilibrium. So we're getting back to sort of a normal marketplace is sort of the way I read it. I also would point out that Silicon Valley seems to be doing a little bit worse than the other areas as far as the overbidding, although San Francisco is probably doing the absolute worst. Visually, it appears San Francisco is the worst, followed by Silicon Valley, and then these other 3 groupings seem to be relatively the same to what they've been historically. Here is looking at the frequency of overbidding. This is just how common is overbidding. It tends to be a little more stable because as the market shifts, people will overbid 1% instead of 10%, but that's still an overbid. The frequency tends to be a little bit more stable, but you can see the trends are the same. You can see we're coming back down. We're getting back down in the order that we have been. But again, San Francisco and Silicon Valley are below what maybe you consider their historical norm, where the other 3 groups are relatively in the same order of their historical norms. Don't know what that means. It may mean simply that Silicon Valley and San Francisco went up the most, and so it had the most to come down, but it's just an observation. Here's looking at price, sold price. The horizontal lines were added so you can see where we're back to appreciation on, and we are sliding further back. We're now getting back to where April of 2020, and that's for San Francisco area. For Silicon Valley, we're moving more back to January of 2021, the very end of 2020. For the greenest Santa Cruz, it's back to, barely where it was in October of 2020. And then you go on to I think this would be in the North Bay. It's back to basically April of 2021. And then you have the Central Valley, the cheapest, and it's roughly going back to April of 2021. Here I just put it on the log scale. The big takeaway for me is notice how close San Francisco and Santa Clara got together. You can see the vertical separation, was bigger here, narrowed down a little bit, was fairly consistent, and then it got significantly narrow shortly after COVID or in this last run up. The vertical separation should really stay the same on a log scale, as you can see in the other county areas. These areas are staying roughly the same, although what I'm also perceiving, and I didn't look at the exact numbers, it appears to me that blue, which is Central Valley, is catching up to probably my suspicion is it's still Central Valley is increasing in price, and it could be simply things like mountain house development and other planned developments that are going out there are newer homes and tend to be more expensive, and that's making up a bigger and bigger percentage of the marketplace as they enter the resale marketplace. Here is a new slight takeoff, and I have one I think that's very similar in a minute. I'm looking at the appreciation, and I'm looking at depreciation over the period of April of 2015 through March of 2016. And the reason I picked that time frame is it was near the beginning. And look, the prices were basically very stable there. They were more stable there than any period of time. So instead of using the 2020 calendar year, I'm now using the real estate fiscal year of April 1st, 2015 through March 31st of 2016. That becomes my base year. Then I plot a ratio of the percentage of appreciation for the different areas. So each area has its own median price and you compare it. And what's noteworthy here, well, one, Silicon Valley did a big run up in 2018, which was sort of interesting. And that was the year we sort of had the 2 appreciations. Normally we have an appreciation earlier in the year, basically first quarter minus last 1 or 2 months. And then we had a second one in August. So you can see the other areas really didn't participate in that markup. And then the other takeaway here is San Francisco seems to be lagging behind right now. But in general, the prices are appreciate roughly the same. It doesn't matter which county a buyer was to purchase in, their appreciation long term is roughly the same, at least the order of magnitudes. Yeah, there's going to be exceptions right through here and right through here, but is that statistical or whatever? And the fact that your came from this level at 100% to 160% and you're that close together, to me is still very close together. And it's the individual property that really matters. Here's to give you a little breakdown of the key numbers for the different areas. So you got the different counties, you got the different metric, then you have market share. So this gives you an idea that Santa Clara County by itself is roughly 11% of the Northern California area. The Northern California area is the 13 counties that I'm looking at. The market share of the Bay Area is 16. For the Bay Area, obviously Bay Area equals 100% of itself. And then although it's not in the Bay Area, San Joaquin is 13% of the market share. Sacramento is huge at 27%. I did not realize it was that large of a percentage. The next highest percentage is Contra Costa at 21%. So those are huge, and they're not included in the Bay Area. If this was in the 100%, it would be 27% of that 100%, but it's not. It's just a way of doing it, and here's your Northern California number. So it's 18% of the Northern California. Then you get over to DUI, the current DUI, the different areas, and you can see Central Valley is clearly slower than the Silicon Valley, the Bay Area, and Santa Cruz, and specifically Monterey is significantly slower as well. I also don't believe that 85.6 down here. I don't know how I got that because that's the highest of all of them. That might be just a copy and paste error. Sorry about that. Sale price to list price average in the different areas. And this is the kind of data that I looked at to sort of pull Contra Costa County out of Silicon Valley. One, it was the price. It was $858,000 versus 1.2 million to 1.8 million. So it was significantly lower on price. The overbidding was significantly lower. The average sale price to list price ratio was in the ballpark. DUI was in the ballpark, but it was basically price and the frequency of overbidding that caused me to pull it out. And I also am trying to not define things myself. And Silicon Valley is defined as sort of Santa Clara, San Mateo, and Alameda counties, which is sort of the deciding factor that broke the tie for me. So anyway, if you want individual numbers, they're all there for you. I'm ready for any questions people have, and you can email individually on my normal business email account, creeksiderealty@gmail.com, because I have that up on a different computer. And if I go see if anyone's unmuting themselves. No one's unmuted. I will move on. Now we're going to look at the old data sort of the Bay Area data, 4 counties, Santa Clara, Alameda, Contra Costa, and San Mateo. And I will go back and clean this up and delete Contra Costa County out of it. It'll be basically Silicon Valley going forward. I haven't had time to do that yet for this week, and maybe even next week. We're looking at the 4 county area. We will be going to 3 counties. Here's your DUI. Everything looks like it's performing normally here. Your DUI is the purple line. You're above the coolest previous year. So we're having the worst year out of the last 10 years, and that's basically very apparent. Here's the Delta DUI. This is where I take the DUI, I subtract the median. So if you're having a normal year, you'd be down here. So DUI is basically 20 days above or slower than where it normally would be at this time of the year. And you can see that just earlier this year and late last year, we were 20 days below or 20 days faster than where you'd expect the market to be. So the market has done a 40-day shift based on where you'd expect it to be, which is pretty significant, from 20 days faster to 20 days slower. Here's looking at the DUI for each county compared to the DUI for the entire group. You can see Santa Clara County in the blue is roughly the best. You can see Contra Costa County is roughly the worst. The other two are pretty close together. together, but all four are fairly close together. Keep in mind a DUI between 40 and 80 is a balanced marketplace. We're in a balanced marketplace. In my opinion, neither the buyer nor the seller, based on this data input, has the upper hand. But based on some other data, I would tend to think the buyers are starting to get the upper hand. The amount of overbidding, the days on market, the lack of sales, and that's the biggest one. We'll get into that a little bit more. Here's the number of offers. You can see the number of offers is continuing to drop down in the four key areas. Yeah, the four key counties. Here's where you'd expect it to be, right there on the black line. The worst previous year was the blue line. The best previous year was the red line. And here we are on the purple line. We're basically selling, instead of 3,100 homes, we're selling about 2,300. So we're short about 800 homes. That's a pretty significant deficit. This is taking the number of offers that we actually had, subtracting the median. So you should be up here, you're down here, and you can see the 800 estimate on the previous chart is pretty accurate. This is 1,000, this is 500, maybe it's closer to 750. It's a little bit higher than 750 and probably under 800, but we're selling that many fewer. You can see the pandemic, we were probably down somewhere around 2,300 fewer. So it's pretty significant, but there's also a huge volume difference. The volume would have been much higher at this time of the year than it is at this time of the year. So the black line is taking the median, it's taking out the seasonal adjustments. Here's the raw count, so you can see the number of offers going through. Santa Clara County is in the blue, but they're all coming down. The yellow, and I'm not sure why my key is different. I think the yellow is San Mateo County because it's the smallest county, so I know it's supposed to be yellow. It's down here. It seems to be a little bit more stable than the other three counties. Here's market share. Santa Clara County, look at it, it's falling. So Santa Clara County is dropping more relative to the other three counties. And that's why this line here, its market share is dropping, where the other three areas, their market share is actually increasing slightly, with the exception of Alameda County looks fairly flat. But two are going up. Even Alameda has a slight upslope, but Santa Clara County has a steep downslope. The other counties are improving at the cost of Santa Clara. Here's looking at active inventory. Again, you'd expect it to be on the black line. And believe it or not, we have below the expected level of inventory. The only explanation I have for that is sellers have had come out. Any seller that wanted to sell or was contemplating selling sold. And now that the market's flipped, we don't have the normal number of sellers that need to sell. And so sellers are electing to delay their marketing until the market improves, which is the only explanation that we have a shortage of inventory at a time frame when we're having record low volume of sales. Here's the inventory, and this is a little interesting because here you're above the median, and here I'm clearly below the median. So I'm not sure why the discrepancy, because the black line's the median. My real data set is here. So I'm maybe 100 listings below, but I come over to this slide and I'm showing myself maybe 150 listings above. I'm not sure what's going on. It's probably my transition. I'll try to get the transition more cleaned up. This is the old data set, so I'm not sure why it's not internally consistent. So I don't have an answer for anybody. Here's the magnitude of overbidding. The outer two lines are basically my quasi-min and quasi-max. They're basically the 2.5 percentile and the 97.5 percentile. The purpose of doing that, it's very intentional. It gets rid of people that report the wrong sale price, and that does happen surprisingly frequently. What I do is I go through the raw data, try to clean it up, and then this quasi-mins and max is to get rid of any ones that I miss. And also, if one property just sells for an outrageous overbid, you don't really want to know that. You want to be very close to the market. So I lose 2.5%. So 95% of the market is between these numbers. The gray lines are your 10 percentile and 90 percentile. So 80% of the market's between these two lines. So you can see that first 15% drop is pretty significant. Then the two paired light green are 25% down at the bottom, 75% of the top, telling you that 50% of the properties are between these two. And then you have the median right at 100, and the average a little bit over 100. That's why I follow the average on the overbid ratio, is you'd expect the overbid to be median at 100 a lot of the time. Half the homes selling above, half the homes selling below, maybe 40% above and 40% below, and 20% right at the asking price. So those are the kinds of things why you'd expect it to be at 100%. And you can see it's been at 100% for some period of time. There was also another long period of time back here when you got significant overbidding. Then you can follow the median. Here's the delta overbidding. This is where you take the magnitude of overbidding, subtract the median for the past 10 years, and this would be for the entire area. And so you can see you're just below the overbidding you'd expect. We got down quite a bit lower and we've been improving. So the overbidding's coming back up. That might be a matter of sellers getting more realistic in their price. Here's the magnitude of overbidding. And again, in this case, it's San Mateo County that's going way down. It's, the lowest that we've ever been for any counties. So I'm going back to 15. Here's the delta overbidding. You can see you'd expect to be on the median. So up here, Alameda County is doing much better than you'd expect it to be doing. The other three counties are doing much worse. San Mateo County is getting worse, except it's turned around the last week. Here's the overbidding. This is where I look at the data for each week and we add on lines. When you have both the red up and the blue down arrow, it's a plateau. So the next data slide coming on is going to be very close to the existing. This is the current line, the purple line, and it's dropped down just a little bit. You'll see that later on. Best line ever, worst line. If the data set pulls away from the axis in the red shaded area, you have a hot marketplace. So in this case, it's pulling away right about at the 45%. So that's a balanced marketplace. Let's start it. There's the first added line right at the same level. Again, right at the same level. Now we went up significantly, went up a little bit, right at the solid line, down, down, way down, down a little bit. And now they're all going to be very similar coming on. See, that one's right on top of it, right on top of it. And you can start to see the purple line, the current week is a little bit below where all these lines are getting added on. That was a small enough difference, and you can see some of the solid lines coming down here a little bit. I called it a plateau, even though it's down slightly. So there's your new solid line here. There's your green solid line, so you can see it starting to fill in. There's the dark blue line through here. There's a red line coming in. So you can see it's a very stable marketplace. There isn't much change, but as you get closer and closer to the blue line, it's harder and harder to move. And the reason I call this plus 1 week, this is using my fiscal real estate year to make annual comparisons better. And that's where I start on March the 1st and do every week. I ignore the 28th of February and leap day. So you lose 1 or 2 days, but that way you're comparing the same date and you always have a number of weeks. I think it's starts on a Tuesday currently. So I fill in to Friday night by calling it the 10th. So it ends on the 2nd, reported on the 3rd, ends on the 9th, reported on the 10th. It's only a partial week, but I go back a full week. It's more that you're not comparing apples to apples, and that's why I call it plus 1 week. Here's looking at the sellers that are getting more than their asking price. So right now, 40% of the sellers are getting more than their asking price. This is looking at the sellers getting under their asking price, and that's about 48%. And then here's the number of sellers getting exactly their asking price, which is about 11%. Here's the frequency overbid. And again, look at San Mateo County just nosediving. Santa Clara County is nosediving the last couple weeks. Contra Costa County is basically flat, and Alameda County is a slight decrease. All of a sudden, we had a huge downturn. We had a little bit of stability, and now it looks like we're going down for another decrease in the frequency of overbidding. Here's the overbidding compared to where you expect it. And Alameda County is the one that stand out. It's doing better than you'd expect. The other 3 counties are still worse, and here you can see the real drop-off in San Mateo County. To me, this is the takeaway slide, and I don't understand why this isn't what the media is harping on. We've only had 500 512 offers accepted back in 2007. This year we had 526. I'm actually calling the 526 a record low. And the reason for that is the 512 number. All the transactions that failed have failed. We're still going to have some late reports, which will increase that number, and then we'll have some failings. My suspicion is this number is going to end up lower. At 498, we're getting very close to 488. I still think that's going to come down. 465, we're not going to catch 393. 571, we're already lower. 555, we're already lower, and then we're up. But basically, the overall takeaway is look at these numbers. You're basically somewhere around the 23rd to 25th worst year out of 25 years. In the last 10 years, you're either 9th or 10th place. And nobody seems to be talking about the volume. And volume is so important. You know, if you sold 100% of your normal volume at 99% of the property value, that wouldn't be a big deal. But now if we're only selling 75%, and even if we sell 75% at 100% of the market, you've still done a whole lot less business. It's the volume that generates transactions. And without volume, eventually prices are going to come down. This lack of volume is significant in my opinion. And the lack of volume is far greater than the lack of inventory. The lack of inventory is only a couple percentage, where this is like 75% of the volume you'd expect it to be. Here's the breakdown of the 4 different counties, and I'll probably be dropping Contra Costa County in the near future, but you can pick up the key indexes and look at it. The 1 week data tends to fluctuate all over the place. It's also interesting, just number of new listings, unchanged in Contra Costa County, down 40% in Alameda County, its next door neighbor. There seems to be a lot more fluctuation. I don't know if it's just because the data set is getting smaller with fewer transactions. Number of offers accepted from a negative 27% to a positive 29%. I mean, it's all over the board. Even when you look at the 5-week data, which is a little bit more stable, you go from a minus 8% to a plus 1%. Way more stable than the 1 week data. And that's why I don't like looking at 1 week data, but it gives you an idea what's happening. And then with closed day data, you get the sale price and stuff. Now we're moving on to the blended data. This is where I add in condos and townhouses, and I look at San Mateo County and Santa Clara County only. I may drop some of this. I don't know. I like it because it gets into micro market shares. This shows you the importance, and it's frankly where I do a lot of my business. It's nice to be able to come in and see the micro market, so I will probably keep it. So here is the color for DUI. The top part is single family homes in both counties, and then condos down below, and it looks like I'm not bringing over the condo data. Here's my heat map. The redder the color, the hotter the marketplace. And when you look at this, a good part of Silicon Valley is a hot marketplace. We're selling the stuff in under 40 days, believe it or not, 38 and a half down to 31 days. A good part of Santa Clara County is still in a very fast-paced marketplace. It's just there's no volume, and that's why the volume is such a big deal. You can see the coast is really cold, but I mean, there was only like 3 properties over there. That's basically because there's no inventory. You're having a statistical fluctuation. Here now is the overbidding. So even though you have a fast-paced marketplace, you can see buyers aren't overbidding in a good portion of Santa Clara County. The only area where they're really overbidding is Cupertino, Sunnyvale area. Now you're looking at the frequency of overbidding. It's basically all blue or white. So you either have a balanced marketplace or a marketplace that's favoring this buyer. Here's sold price. This has nothing to do with the speed of the marketplace or the condition of the marketplace. It's simply where the median price tends to be Redwood City. If you're blue, you're below the median price. If you're red, you're above the median price. The western part of Santa Clara County is a more costly than Redwood City. The coast is a little bit cheaper. The real inexpensive areas in the local marketplace are the southeast area of Santa Clara County and the north area of San Mateo County, which is cheaper than the Redwood City area. Here brings the key components over so you can look at your micro market area and understand the market conditions you're going to experience. Or you start over here on your price with the median being the middle, the number to the left being the cheapest 10 percentile, the number to the right being the 90 percentile, the most expensive 10%. You can see Santa Clara County single family homes has a shortage, only 88% of the homes you'd expect it to have. San Mateo County, just one border over, has 150%. It has more inventory than you expect. Santa Clara County condos coming in about 124%. DUI is the balance, and you can see all fairly good. 40 to 80 is a balanced marketplace. We're basically around 50, except for the Bay cities, which is up around 75, which would tend to indicate that there's a little bit more supply than there is demand in that particular area. Here's the magnitude of overbidding this week versus last week. And you can see we're basically 99 percentile, 98.8%. And then you come up to frequency overbidding. It's somewhere right around 30%. Santa Clara County single family homes is the highest at 37%. The least is the Bay Cities condos at 22%. And now let's start looking at these appreciation numbers. These were 44%, 37%, 34%, and 17%. And now they're 10%, minus 0.2%, 10%, and minus 4%. So we've lost almost all the appreciation, and this is still based off the 2020 calendar year. Here's comparing close to apples and apples. I'm using November. Next week, I'll have both back, but I normally get this data on December the 6th. This was gotten on December the 10th. It's pretty apples and apples comparison. We'll jump down and look at the volume of sales. I think that says 510. And if we come back to 2007, it looks like we're 672. You're 160 homes shorter on 600, so that's about a 25% missing of your previous worst year. And again, I think that's the real takeaway. Closings aren't as bad yet. You're at 560. Your previous low was 598. It's closer because this drop in volume is just now working through. That's the slide you get at the beginning if you get on before me. And with that, I'm open for any questions. And I am looking for feedback on whether people want 10-year history or 5-year history. Appreciate any feedback on covering the bigger area, whether that's beneficial to get a better idea of what's happening globally. I do have the data for each county. If anybody reaches out to me, I'd be happy to provide the county that they're interested for, because it only takes a couple minutes of printing it out and sending them to in a PDF. If you want any of the 13 counties specifically, that's fairly easy for me to do, and I'd be happy to do that for people. Any questions from anybody? Not seeing any unmuted mics. I'll call it a week. Bye, everybody. Take care.